In today's Short Selling 101, we are going to look at a stock loan. This is one of the most misunderstood processes in the capital markets and very often overlooked by investors. Luckily, Sam Pierson of IHS Markit is an expert in the stock loan space. In this video, Sam is going to walk us through the logistics of how a short seller can borrow a stock in order to short it. He'll also explain a few of the risks that short sellers might encounter in this process. There's quite a lot to unpack in this key part of the short selling framework. So let's jump right into Sam's 101 on the stock loan market and its mechanics.
What is stock loan? We're talking about the borrowing of equities. And so it's a subset of all of securities lending where there might be borrowing of government bonds or corporate bonds. And so when you talk about stock loan, you're talking about the equity portion. And so what's happening is that a short seller is borrowing the shares from someone who owns them. And so there's a market for that borrow transaction. As an example of how this works, if you imagine a hedge fund today wants to short sell a stock, they'll reach out to their prime broker and get what's called a locate, which is the reasonable assurance that they'll be able to borrow and deliver those shares. And then at some point in the future, the short seller will purchase the shares back in the market and return them to the original owner. So thinking about short selling in the context of gambling or sports gambling, an analogy might be betting the don't pass line in a game of craps. Generally, the rest of the table is betting on a single outcome, and you're betting kind of on those outcomes, on the positive outcome not coming to pass. The easiest way to think about short selling is as a part of a portfolio. Usually, these are going to be long-short funds that are long some portfolio stocks and short others. So the simplest way to think about it is as a hedge. So usually, there's going to be some long that's set against that short. Maybe it has some relationship to it in the sense of being a pairs trade. Maybe there's an arbitrage between different securities that reference the same entity. It might be a directional short sale, an outright bet on the share price declining. We think about this in a simple sense, and this might be a little bit of a dated analogy for some of the viewers out there, but if you remember going to a Blockbuster video to rent a video or a DVD on a Friday night. There might be the new release. That's the hot movie. That's the one that everybody wants. Those are going to be $5, $6. It's the most in-demand video right now. There might be a selection of old movies that nobody really wants, that there's not a lot of demand for, and you could get those for $1. And so when you're thinking about how expensive to borrow a security is, it's going to be a matter of supply and demand. There's going to be, if it's a hot stock, there might be a lot of demand, and the demand might be so great that it's hard to borrow, even though there's a fair amount of supply. Not at this current moment, but Tesla historically has fit into that, where there were many billions of dollars worth of borrow demand. So even though it was a reasonably large market cap, there have still been times where it was hard to borrow. Probably one misnomer about short selling is people often think of the big short or think about it as more of an asymmetric bet where you bet a little to win a lot, which is more of a derivative structure. But in actual short selling where you're borrowing the shares and selling them short, you're not really having that asymmetric payoff. You're just, you're short at $10. When it comes to borrowing shares, every day there'll be a payment that's made for most shares most of the time. They'll be easy to borrow, which means that there wouldn't really be a security-specific negotiation about the borrow cost. But there will be a subset of equities that are hard to borrow or called specials. And there will be a negotiation of what the borrow cost should be, and then that will change over the course of time. And so managing that borrow cost is an important part of a short sale. Most stocks, most of the time, will be general collateral, which will be a borrow cost of less than 1%. The quoting of those rates is as an annualized cost. So meaning that if you were short Apple over the course of a year, it would cost you less than half of 1% in borrow cost. So that would be most of the stocks, most of the time will fall into that camp. And then for the hard to borrow shares, we haven't really gotten to an upper bound yet. I mean, the theoretical upper bound would be 36,500%, which would mean that you were basically paying the full value of the stock every day. It becomes a meaningful part of the short sale and of owning the shares in the short run. There isn't a hard and fast rule for what exactly is a special. I think probably if you were going to pick a dividing line, 500 basis points or 5% a year is probably a reasonable place to be in terms of what is or isn't a special, and something that's from, say, 50 basis points to 5% might be a warm stock. So where it's differentiated from the easy to borrow mega cap stocks, but it isn't yet something where, as a borrowed cost, it's going to be hugely consequential in terms of how the position works. So in most cases, the borrowing is going to be an overnight transaction. And that's where there's an opportunity for rates to change over the course of an open loan that might run for a few months. That initially there'll be a borrowed cost, and then it will change over the course of time with the supply and demand trend. In terms of why something would be hard to borrow, there's always going to be a supply and demand component. So for something that's a large cap, the amount of demand that's required for it to be hard to borrow is much greater, but you can certainly get there. Versus for, say, a $500 million market cap company where it doesn't really take very much in the way of short demand to get to the point where it would be reasonably crowded as a borrow. But usually when we're talking about the few 100% annualized borrow cost, it's going to be in an equity where there's some sort of an arbitrage trade, and it's not just that the crowding got to that point. Another similar thing would be corporate actions, potentially proxy votes, where holders will recall shares to vote them, and that can add to crowding in terms of the ability to borrow shares. When you're looking at borrow cost, it is a component in a short squeeze. And that's part of why you look at securities finance data in addition to the short interest data to say, not just are there a lot of people that are short, but is it a lot out of what could be shorted, out of the supply that's being made available to short sellers of shares to borrow. And so when you look at something that's really expensive to borrow and there isn't very much remaining supply, you know that it will be hard for short sellers to add to that position. That's kind of the kindling for a short squeeze. And then if something incrementally positive happens to that stock, it could cause a lot of short sellers to want to exit quickly. And it's also a situation where it might be harder to add on to a marginal short position. And so you could have a situation where the share price increases dramatically over a short period of time. The key pieces of information are going to come from how many shares are available to lend, what that represents as a portion of the shares outstanding. So is this a case where there's already going to be, just naturally by virtue of a limited supply, something that becomes harder to borrow more easily? In terms of the metrics that are going to be important to the different stakeholders, probably the most important is the concept of utilization, which is what percentage of the supply that the lenders have that they might lend out of a given security are already on loan. You could think of the utilization of shares as being a leading indicator for borrow cost. If there's 95% of the shares that could be lent out already are, the likelihood is that that's already going to be somewhat hard to borrow. Versus something that has less than 5% of the shares in lending programs already being used. That's going to probably be easy to borrow, and you'll also have a certain amount of guidance that it's going to stay being easy to borrow, barring some substantial increase in borrow demand. Starting from that side of the securities lending value chain, you move through to more of a trading perspective on the part of the banks and prime brokers who are arranging the borrow transactions. And they're looking at pricing of a borrow on a day-to-day basis, looking at should there be a re-rate of an existing borrow. I'm looking at new names that are getting hot, and from a borrow demand perspective, maybe looking at some of the already hot names and looking at maybe there's something going on from a supply perspective that's going to change what's going on with that borrow. And ultimately that then leads into the hedge fund side, where they're managing the borrow of a short position and trying to make sure that they're paying the best price that they can for the borrow, but also making sure that their borrow is stable, making sure that they're giving portfolio managers a heads up if something's getting more crowded, that either the borrow cost might go up, there might be a challenge in being able to borrow more if we want to add to this position. Potentially now is the time to term a borrow and have greater insight into what it's going to cost over a period of time. From the perspective of a prime broker, they're managing these borrows for their hedge fund clients. And so they're providing insights about how expensive it is to borrow now, setting expectations for whether it could become harder to borrow in the future, and making sure that they're borrowing in any shares that they need in order to deliver them. So the prime brokers are managing an internal inventory of shares, and they're also borrowing in shares as they need them to settle those short sale trades and avoid having failures to deliver. So as we think about the securities finance value chain, it's important to think about it all the way through from the hedge funds who are borrowing shares to the owners of the shares who are lending them out. And so when we're talking about borrow cost for hedge funds and what they're paying to maintain their short positions, the other side of that is income for the owners of securities who are generating an additional return by lending them out.
So let's recap what Sam said. A long investor likes to buy stocks at a low price and sell at a high price. The short seller is working on exactly the same principles, but in the reverse order. They want to sell the stock at a high price and then buy it back at a low price. That means there is a market for loaning out and borrowing stocks. Sam outlined how these costs can vary based on scarcity, just like any other market. Sam highlighted the following points to consider from the stock loan market when thinking about short-selling stocks. Short sellers need to borrow stocks from a pool of long holders, such as asset managers. This is the stock loan market in which each stock is given a borrow cost based on its scarcity. Borrow costs can increase and decrease during the loan, often based upon how many shares have already been loaned out, called utilization. Risks on a short position are unlimited because stocks can potentially rally indefinitely. This is called a short squeeze, and that's probably the biggest risk to watch out for. We hope you enjoyed this short selling 101 on stock loans. Thank you, and see you next time.